Every single month that you make a mortgage repayment in Australia, your bank pockets $929 in pure profit. Not interest, not fees. Pure profit. And last year, while you were cutting back on groceries and petrol, Australia's Big Four banks made $43 billion. Here's exactly how it breaks down, city by city. Let's start with a number that stopped me cold when I first read it. $228,900. That is the amount of profit, not revenue, not interest collected, but actual profit that Australia's Big Four banks make from a single average home loan over its 30-year life. This is not a conspiracy theory. It's not political commentary. It's research published by the Australia Institute, one of the country's most respected independent think tanks, and the numbers are genuinely staggering. The average Australian home loan right now sits at $736,000. Over the life of that loan, your bank will collect far more than just the principal and a reasonable return. They will extract nearly $250,000 in pure profit. In the very first year alone, the bank makes $11,110 in profit from your mortgage. That's $929 every single month, $214 every single week. That money isn't going toward your equity. It isn't reducing your debt. It is flowing directly to a bank's bottom line. And the banks are doing just fine. According to KPMG's full-year analysis, Australia's Big Four banks, Commonwealth Bank, Westpac, NAB and ANZ reported a combined profit after tax of $29.8 billion in FY 2025. To contextualise how obscene that figure is, lending money to Australian homeowners is now almost as profitable as mining. The Commonwealth Bank alone posted a record cash net profit after tax of $5.45 billion for just the first half of the 2026 financial year, a 6% increase on the previous year. The Guardian reported this was driven in significant part by record home loan volumes, with investors accounting for 2 in every 5 new home loans issued in the last quarter of 2025. Here's what makes this particularly sharp. According to the Australia Institute's research, while owner-occupier mortgages make up just 22.7% of the Big Four banks' total loan book, they account for 39.3% of total bank profits. Owner-occupiers, the everyday Australians buying family homes, not investors, not corporations, are carrying a wildly disproportionate share of the bank's profit generation. Dr. Richard Dennis, company CEO of the Australia Institute, put it plainly. Australians are getting smashed at the petrol pump, smashed at the supermarket, and smashed on their energy bills. But no other companies make anything close to the profits the Big Four banks are taking from mortgage holders. Now, let's take this national picture and walk it through what it actually looks like in each of Australia's major cities, because the experience of carrying a mortgage in this country is not equal, and the pressure is not distributed evenly. Sydney. Sydney is where the numbers become almost surreal. As of April 2026, the median house price in Sydney sits at approximately $1.83 million, according to Cotality data. The median dwelling value, which includes units, is around $1.3 million. At those prices, a 20% deposit alone requires $366,000 for a house. Domain's 2026 First Home Buyer Report found that it now takes a typical household in Sydney 7 years and 7 months to save a 20% deposit for an entry-level home. 7.5 years of disciplined saving, while rents simultaneously consume a massive chunk of income, while house prices continue to rise, and while the target keeps moving further away. For those who do manage to secure a mortgage in Sydney, the repayment burden is crushing. According to a Guardian Australia analysis, servicing a new mortgage now eats up approximately 45% of a median household's pre-tax income, up from just 26% in September 2020. That figure has nearly doubled in 5 years. When you layer the Australia Institute's finding that banks are pocketing $929 per month in profit on an average loan on top of a Sydney-sized mortgage, the profit extraction figure would be considerably higher. Roy Morgan data from March 2026 shows that 26.8% of mortgage holders nationally are now classified as at risk of mortgage stress, a figure that has risen sharply since the RBA began hiking rates again in 2026 after a brief period of cuts in 2025. The Australian mortgage rate, as reported by Trading Economics, climbed to 5.73% in February 2026. In Sydney, where loan sizes are the largest in the country, even a 0.25% rate hike translates to hundreds of additional dollars per month flowing directly into bank profits. Melbourne. Melbourne presents a slightly different lens on the same fundamental problem. The city has underperformed its East Coast peers on capital growth over the past 2 years, and that relative softness has made it the most affordable of the big 3 capital cities, a title that would have seemed unthinkable a decade ago. Yet, most affordable is deeply relative. Melbourne's median dwelling value still sits in a range that requires a loan well above the national average of $736,000 for most buyers. What's particularly notable in Melbourne is the investor dynamic. Macro business data through the first quarter of 2026 shows that Sydney and Melbourne recorded either flat or slightly negative price growth, while demand in the rental market remains tight and vacancy rates stay well below the 2% threshold needed for a balanced market. Investors in Melbourne are not getting the capital growth rush that Perth and Adelaide buyers have enjoyed, but they are benefiting from strong rental returns in a market where tenants have very few options. KPMG's residential property outlook for 2026 actually tips Melbourne for 6.6% house price growth across the full year, which would represent a meaningful recovery from its recent underperformance. But for mortgage holders already in the market, the combination of higher rates in 2026, land tax changes that have squeezed investor economics, and stagnant wage growth means the bank's $929 monthly profit is biting hard. Melbourne mortgage stress suburbs have been widely reported, with some outer ring suburbs seeing near universal financial pressure among households. Brisbane. Brisbane's transformation from affordable lifestyle city to genuine million-dollar market is one of the most significant property stories of this decade. As of early 2026, Brisbane's median house price sits at approximately $1.11 million according to Cotality, up from under $600,000 in 2020. That means a buyer entering the Brisbane market today with a standard 80% LVR loan is carrying a mortgage of around $888,000. Run that through the Australia Institute's methodology and the bank profit picture becomes stark. On an $888,000 loan at current rates, the profit extraction over 30 years would substantially exceed the $228,900 figure calculated on the national average loan. ANZ is forecasting Brisbane house price growth of 9.7% across 2026, which means values could push toward $1.2 million before the year is out. The city that once offered an affordable escape from Sydney and Melbourne pricing is now generating Sydney and Melbourne scale bank profits on its mortgages. Brisbane's rental vacancy sits at approximately 0.9% according to Cotality's April 2026 Home Value Index. For context, a healthy rental market means vacancy around 2% to 3%. Brisbane renters are competing for almost no available stock, paying rents that have surged significantly over 3 years and watching the purchase market move further out of reach. Domain's 2026 First Home Buyer Report estimates it now takes around 6 years and 3 months to save a 20% deposit in Brisbane, meaning a young couple starting to save today, even with discipline, won't be buying until well into the 2030s, by which point prices will have moved again. Perth. Perth is the city that has handed banks their most extraordinary profit windfall of the current cycle. The Western Australian capital recorded annual house price growth of 17.2% in 2025, the strongest of any capital city. As of early 2026, Perth's median house price has crossed $1,087,862, according to REIWA data. A city that was selling homes at roughly $500,000 4 years ago. KPMG forecasts a further 12.8% growth for Perth in 2026, which would push the median toward $1.23 million. The loan sizes being written in Perth today are at levels that were unimaginable in that market just a few years ago. Rental vacancy in Perth sits at 1.1%, the second tightest in the country, meaning both renters and buyers are trapped in a market of extraordinary scarcity. Strong mining sector employment has supported demand. Interstate migration has flooded in, and supply has not kept pace. The winners in Perth are undoubtedly those who owned property before 2021. The winners, who are less visible but equally real, are the banks, writing ever larger mortgages on ever higher valuations, generating ever greater profit from a population that simply has no other option if they want to own a home in Western Australia. Adelaide. Adelaide's property story in 2026 is being driven by some of the strongest underlying economic fundamentals the city has seen in a generation. A UKS submarine infrastructure investment, a growing defence technology sector, and consistent population growth have given Adelaide an economic backbone it previously lacked. In January 2026, Adelaide house values rose 1.3% in a single month, 4.8% over the quarter, and 9.7% year-on-year. Adelaide's median house price is now approaching or exceeding the $1 million mark, depending on the data source used. For a city historically associated with affordability, this is a seismic shift. The rental vacancy rate in Adelaide has been reported at just 0.9%, the tightest of any capital city in the country. Renters in Adelaide are experiencing some of the most intense competition for housing in Australia, while simultaneously finding the pathway to purchase increasingly expensive. For Adelaide mortgage holders, the combination of rising rates in 2026, rapidly increasing loan sizes, and the Australia Institute's documented profit extraction formula means that the banks are benefiting enormously from Adelaide's boom, just as they are from every other city's. Canberra. Canberra operates at its own quiet frequency in this story. The national capital's median dwelling value sits at approximately $892,800 as of the March 2026 quarter, with annual growth of 6.1%. It is a market of unusual stability. Government employment floors income, professional households have stronger than average borrowing capacity, and the ACT's tight land release policy keeps supply constrained. But stability does not mean immunity. Canberra mortgage holders are carrying substantial loans, and the same bank profit structure applies uniformly across the country regardless of postcode. The households in Canberra's leafy inner suburbs, making diligent fortnightly repayments, are contributing the same $929 per month in bank profit as their counterparts in Western Sydney or Outer Brisbane. The mechanism does not discriminate by geography. It operates wherever there is a mortgage. So, what does this all mean? Here is the most important thing to understand about the data we have walked through today. The $228,900 profit figure is not a mistake or an aberration. It is the designed outcome of a system in which Australia's banks occupy an extraordinarily privileged position. The median house price nationally now stands at 8.9 times annual income, according to Cotality data cited by Forbes Australia, up from around 6 times income just a decade ago. As prices rise, line sizes rise, and bank profits on each individual mortgage rise in lockstep. Meanwhile, according to ABC News reporting, renters who never achieve home ownership will need approximately $300,000 more in superannuation than homeowners to fund an equivalent retirement. The wealth gap between those who own property and those who do not is structural, compounding and widening with every year that passes. It is not just a housing story. It is an intergenerational wealth story, and the banks sit at the center of it, collecting their $929 every single month from every single mortgage holder in every single city across this country. The question this raises, and it is a fair one, is not whether banks should make a profit. Of course they should. The question is whether this level of profit extraction at this scale from this specific group of Australians who are simply trying to own a home is a system working as it should. The Australia Institute's research suggests the answer is no. The data from Roy Morgan, KPMG, Cotality, the RBA, and Domain all paint the same picture from different angles. You now have the numbers. What you do with them is up to you.